When you're looking at investments, sometimes things look almost identical. Same index, trade the same way, even sound the same, ET something.
Right.
But underneath,
Right.
totally different beasts. And missing those differences, well, that can really open you up to risks you didn't even see coming.
It really can. It's one of those classic finance things where the name sounds similar, but the plumbing underneath is completely different. You see exchange traded, you see it tracks, I don't know, the S&P 500 or gold, and you think, okay, it's like an ETF.
Yeah, just another flavor of fund.
But it's not. The actual structure of an ETN versus an ETF, well, couldn't be more different. And getting that wrong is where people can get burned.
So that's our mission today in this deep dive. We're going to really pull apart these two members of the exchange-traded product family. You've got the ETF exchange-traded fund. Everyone kind of knows that one.
The popular kid.
Exactly. And then its lesser-known cousin, the exchange-traded note, the ETN. We've gone through a bunch of sources, finance education sites, some deep research, even a transcript talking about, well, some recent trouble for ETN holders.
Yeah, some real-world pain.
Right. So we want to make crystal clear what each one is, what those crucial differences are, and really hammer home the unique risks, especially with ETNs, that just aren't there with the standard ETF. It's about knowing what you actually own.
We'll start kind of broad, talk about the whole ETP category they fit into. Then we'll really spend time on ETFs, how they work, the pros, the cons, maybe some things people overlook.
Okay.
Then we switch gears to ETNs. That's where I'll focus hard on the risks, the structure, credit risk tax stuff, which is complicated. And yeah, we'll use those real examples from the sources to show what can actually happen, like that delisting mess.
Sounds good. A lot to peel back here.
Yeah.
So let's start with that umbrella term, ETPs, exchange-traded products. What puts something in that bucket?
Basically, ETP is the big category. It covers different types of investments designed to track something, an index, a commodity, a currency, whatever. And the key thing, the ET part, is they trade on stock exchanges during the day, like stocks.
So not like mutual funds where you get the price at the end of the day.
Exactly. That intraday tradability is the defining feature of the whole ETP family. They offer that flexibility.
Okay, so they all trade like stocks. Got it. But as you said, what's inside or behind that trading symbol can be very different.
Massively different. Which brings us to the big one. The ETF. Let's really dig in here. What is an ETF fundamentally? How does it give you that S&P 500 exposure, for instance?
Right. What am I actually buying?
Think of it like a basket. The ETF is the basket, the fund itself. And when you buy a share of the ETF, you're buying a tiny piece of that basket.
Okay.
And inside the basket are the actual assets. So for an S&P 500 ETF, the fund literally goes out and buys shares of Apple, Microsoft, Amazon, all 500 companies, usually in the right proportions.
So I indirectly own a sliver of all those companies.
Precisely. You have a beneficial ownership stake in the stuff the fund holds. It's a bit like a mutual fund in that sense, pooling money to buy assets. But the trading, as we said, is the big difference.
Right. The stock-like trading, that's got to be a major advantage.
Oh, huge. Mutual funds, priced once a day, after close, you put in your order, cross your fingers, wait to see the price. ETFs, trade all day long, you see the price change, you can buy, sell, set limit orders, stop-loss orders.
You can short them. Buy on margin.
Yep. Short selling, margin, options trading. You can do all that with liquid ETFs, just like with a heavily traded stock. That flexibility is key for many strategies.
And the popular ones, they trade a lot, right? Liquidity must be good.
Massive volume on the big ones. And that's critical because high liquidity usually means a tight bid-ask spread.
The difference between the buying and selling price.
Exactly. A narrow spread means you're not losing much just to get in or out of the trade. It makes trading cheaper, more efficient. Closely reflects the underlying value.
Okay, flexibility, liquidity. What about diversification? That seems like the main reason many people use them.
It's probably the biggest draw for most individual investors, especially starting out. One trade, one ETF share, and boom, you own a piece of maybe hundreds, even thousands of stocks or bonds.
Across different sectors, maybe different countries.
Exactly. Trying to build that yourself. Buying each stock one by one, forget it. The transaction cost alone would kill you, never mind the time and effort. ETFs just package it up.
Like buying the whole cake instead of just the ingredients, and usually cheaper ingredients, right? Lower fees.
Generally, yes. Especially for the plain vanilla index tracking ETFs. Because they're passively managed just following an index, not paying a star manager to pick stocks, the expense ratios are typically way lower than actively managed mutual funds.
Less management, less trading inside the fund.
Right, fewer internal costs, and usually no sales loads like some mutual funds have. Those lower fees really add up over the long term. It's a big performance advantage.
Makes sense. Every 0.1% counts over decades. What about dividends or interest from the stuff inside the basket?
Good question. For most ETFs, the standard structure, those dividends or interest payments from the underlying stocks or bonds, get reinvested back into the fund pretty much right away.
So it starts compounding faster.
Yeah, potentially a tiny bit faster than some mutual funds where there might be a slight delay. Now, there's a less common structure, union investment trusts, or UITs, where dividends might sit as cash for a bit, causing a little dividend drag. But most common ETFs reinvest quickly.
Okay, efficient reinvestment. And taxes. People always talk about ETFs being tax efficient. Is that true?
They tend to be, yes, especially compared to actively managed mutual funds in a regular taxable brokerage account. The reason goes back to that passive tracking.
Because they're not buying and selling all the time.
Exactly. An active manager might sell a winning stock, realizing a capital gain. That gain has to be distributed to the fund's shareholders each year, and you owe tax on it, even if the fund's overall value went down.
Wow, okay. So you could get a tax bill even if your investment lost money overall.
It happens with active funds. Passive ETFs, because they mostly just hold the index components, generate far fewer internal capital gains. So you usually don't get hit with those unexpected tax distributions. You typically only pay capital gains tax when you actually sell your ETF shares for a profit.
That's a significant advantage for buy and hold investors in taxable accounts. Minimizes the annual tax bite.
Definitely. And one more thing, the price on the exchange versus the value of the assets inside, the net asset value or NAV, how close do they stay?
Yeah, can the price get way out of whack?
Not usually, thanks to something called the creation-redemption mechanism. Basically, big players, market makers, can swap large blocks of the underlying assets directly with the ETF issuer for ETF shares or vice versa.
Okay. How does that help?
Well, if the ETF starts trading on the exchange for more than its NAV, these guys can buy the cheaper underlying assets, trade them to the issuer for new ETF shares, and sell those expensive shares on the market for a profit. Pushes the price down. Exactly. And if the ETF price drops below NAV, they do the reverse. Buy the cheap ETF shares, redeem them with the issuer for the more valuable underlying assets, and sell those assets. Pushes the price back up.
So this arbitrage constantly pulls the market price back towards the actual value.
Pretty much. It keeps ETFs trading very close to their NAV, unlike, say, closed-end funds, which lack this mechanism and can drip to big discounts or premiums.
Okay, that's a lot of positives. Flexible trading, diversification, low cost generally, tax efficiency, price tracking. Seems almost too good to be true. What are the catches? The downsides?
Well, nothing's perfect. One potential issue is diversification in very specific areas. If you want exposure to, say, small cap stocks in a particular emerging market, the only available ETF might track an index that only includes the larger, more liquid companies there.
So the ETF is only as diversified as the index it tracks, and sometimes the index itself is narrow.
Precisely. You're buying the index, warts and all. Another point, maybe a bit ironic, is that intraday trading capability.
How is that a downside?
For a long-term investor, seeing the price jump around all day can be tempting. It can trigger emotional reactions, lead you to trade too much, maybe panic sell during a dip, messing up your long-term plan. The very flexibility can encourage bad behavior if you're not disciplined.
The temptation to tinker. I can see that. What about costs again? We said low, but are there scenarios where they might not be?
Compared to active funds, usually low.
Yeah.
But if you compare buying one share of an ETF versus one share of a single stock, the ETF still has that management fee, the expense ratio. The stock doesn't.
Right. There's an ongoing fee with the ETF.
And for really thinly traded niche ETFs, the bid-ask spread we talked about can actually be quite wide. A source mentioned that for some illiquid ones, the spread cost alone could make it potentially cheaper just to buy a few of the main underlying stocks directly, if that's feasible.
So low cost isn't universal. Depends on the specific ETF and what you compare it to. And dividends. You might get less income than owning specific stocks.
Yeah, if you hold a broad market ETF, you get the average dividend yield of all the companies in it. If your main goal is high current income and you're willing to take on the much higher risk of owning just a few individual stocks, you could potentially pick specific high-yield stocks that pay out more than the ETF average.
But way more concentrated risk doing that.
Absolutely. Way more risk. Now,
Yeah.
There's a type of ETF we really need to flag. Leveraged and inverse ETFs. These need a big warning label.
Okay, what's the deal with those?
These use derivatives, sometimes debt, to try and deliver, say, double 2x or triple 3x the daily return of an index, or the inverse, -1x, -2x, -3x of the daily return. Keyword, daily.
Just for one day.
Only for one single day. That's their stated objective. Holding them longer than a day is where things get really tricky and potentially disastrous.
Why? What happens after one day?
Compounding math bites you. Because they reset daily, the effects of volatility mean their long-term performance can diverge massively from just, say, doubling the index's total return over a week or a month. It's called volatility decay.
Can you give an example?
Yeah, a source had a great one. Imagine an index goes up 1%, down 1%, up 1%, down 1%, and so on for 8 days. It ends up exactly where it started, 0% return.
Okay, flat over 8 days.
Right. But a hypothetical 2x leveraged ETF tracking that same index held over those 8 volatile days because of the daily resetting and compounding. It would actually be down over 2%.
Whoa. The index is flat, but the 2x ETF loses money just from the volatility.
Exactly. The daily path matters immensely. That's why these are not suitable for buy and hold investors. They're really short-term trading tools for sophisticated users who understand the mechanics, but they're easy to buy on an exchange.
So inexperienced folks might jump in thinking they'll double their money if the market goes up long term, but end up losing due to the structure.
It happens all the time. Very risky if you don't know exactly what you're doing and monitor them constantly.
Okay, definitely noted. Avoid those unless you're a pro. So summing up standard ETFs, who are they generally good for, based on the sources?
The consensus is they're great for a huge range of people. Long-term savers, people making tactical bets, and especially beginners. They offer that instant diversification at low cost, making it much easier to build a solid portfolio than picking individual stocks. Less homework required.
A simpler path to getting invested.
Yeah.
And the biggest risk with a normal ETF, if you just buy a broad market one.
It's just market risk. Plain and simple. If the market or sector your ETF tracks goes down, your ETF goes down with it. S&P 500 drops 30%. Your S&P 500 ETF drops about 30%. Your fate is tied to the underlying market.
Okay, that covers ETFs pretty thoroughly. The good, the bad, the ugly with leverage. Now, let's make that shift. We focus on ETFs because they own assets. But ETNs, exchange-traded notes, this is where the ground really shifts under your feet, right?
This is the absolute crux of it. ETFs own assets. ETNs do not. They might track the same index, trade on the same exchange, but structurally, fundamentally, they are completely different. And that difference introduces a whole new layer of risk.
All right, let's break down that ETN structure then. What is it if not a fund owning assets?
An ETN, at its core, is an unsecured debt note. Think of it like a bond, or maybe simpler, an IOU issued by a financial institution, usually a big bank.
An IOU. So when I buy an ETN,
You're essentially lending money to that bank. You are not buying any underlying stocks or bonds or commodities. The bank, in return, promises to pay you, at maturity, a return based on the performance of whatever index the ETN is tracking, minus fees.
So wait, ETF, I own a piece of the assets. ETN, I own a promise from the bank. That's it.
That is the fundamental difference. And it leads straight to the biggest additional risk. Both have market risk, right? If the index goes down, the value drops.
Sure.
But with an ETN, you add credit risk, also called issuer risk or default risk.
Credit risk. The risk the bank that owes me the money can't pay.
Bingo. If the bank that issued the ETN runs into serious trouble, goes bankrupt, they might default on that promise. And even if the index the ETN tracked did fantastically well, you, as an ETN holder, are just an unsecured creditor. You could lose everything or get pennies on the dollar.
That's huge.
Yeah.
With an ETF, if the manager like Vanguard or BlackRock went bankrupt, the fund's assets are separate, right? Held for the shareholders.
Exactly. ETFs and mutual funds are typically set up as separate legal entities, trusts, or companies whose assets are segregated for the benefit of investors. They're not on the manager's balance sheet. But an ETN is a liability on the issuing bank's balance sheet. If the bank goes under, your investment is part of the bankruptcy pool.
That's a critical distinction. And there's a very famous, painful example of this ETN credit risk, isn't there?
Lehman Brothers. When they collapsed in 2008, they had issued several ETNs, people holding those notes, wiped out, pretty much. Got very little back in the bankruptcy. It wasn't because the indexes collapsed at that exact moment. It was because Lehman defaulted. A brutal lesson that your ETN is only as good as the bank backing it.
Wow. That really hits home. It's a risk completely absent from a standard ETF. What about oversight? Is that different too?
Yeah, another key structural point. ETFs usually have a board of directors, legally required to look out for the shareholders' interests. ETNs, nope, they're debt. The issuer calls the shots based on the prospectus. There's no independent board representing you.
So the bank makes all the decisions.
Pretty much. And one source even raises the concern that the bank's own trading or hedging activities related to the ETN might not always align with the investor's best interests. There's potential for conflict there.
That lack of independent oversight feels a bit unsettling. And income. ETFs can pay dividends. Do ETNs?
Generally, no. Since the ETN doesn't hold the actual assets, there are no dividends or interest payments flowing through directly to you. The value of any income the underlying index might generate is just factored into the final payout the bank promises at maturity or when you sell.
Okay, so let's recap the core ETN differences. It's debt, not ownership. Adds major credit risk. No independent oversight. Usually no income distributions. Given all that, why would anyone buy an ETN? What's the appeal?
It seems counterintuitive, but there are a few specific reasons, niches really, where ETNs might appeal to certain investors who understand the risks. One has to do with tracking error.
We mentioned that with ETFs, the fund might not perfectly match the index.
Right. Due to costs, or maybe the index is hard to replicate perfectly, especially if it holds liquid stuff. With an ETN, the bank promises to deliver the index return minus fees at maturity. They take on the burden of figuring out how to hedge that promise. So theoretically, the ETN could track the index more perfectly at maturity than an ETF trying to hold the physical assets, especially over long periods or with tricky indexes.
So the promise itself eliminates the tracking challenge, at least on paper until maturity. What else?
Niche access. This is a big one. Sometimes an ETN is the only way to get exchange-traded exposure to a particular asset class, strategy, or index. Maybe regulations prevent an ETF structure, or the underlying assets are just too difficult for a fund to hold directly and track efficiently.
Like what? Commodities? Currencies?
Yeah, things like commodities, futures indexes, specific currency pairs, certain volatility strategies, or even, as we'll discuss, cryptocurrencies in some markets. While ETFs cover a huge range now, ETNs can sometimes fill those really obscure gaps where an ETF just doesn't exist or isn't practical.
Okay, so unique access sometimes.
Yeah.
And taxes. You hinted the tax treatment might be an attraction.
Yes, this is often highlighted, but it's complex. For most ETNs in the U.S. that aren't linked to currencies, the general agreement laid out in the prospectus between the issuer and investor is to treat them as prepaid forward contracts.
Okay. What does that mean for my tax return?
The main benefit is usually tax deferral. You typically don't owe taxes on the ETN's appreciation each year. You only recognize a gain or a loss when you sell it, it matures, or the issuer calls it back.
So no annual tax bill just because it went up in value?
Generally, no. And when you do sell or it matures, the gain or loss is typically treated as a capital gain or loss long-term if held over a year, short-term if less.
That deferral could be nice. Push taxes off into the future.
It can be. But, big caveat, currency ETNs are different. Those usually generate ordinary income or loss, not capital gains. And as we'll get into, even the capital gains treatment for others isn't always straightforward or guaranteed. Tax advice is crucial here.
Okay, so potential attractions, maybe better tracking at maturity, unique market access, and potential tax deferral. But let's swing back hard to the risks beyond just the market going down. We hit credit risk with Lehman. What about liquidity and that price versus value issue?
Liquidity can be a massive problem for ETNs that aren't popular. Just like obscure ETFs, some ETNs barely trade. Low volume means the bid-ask spread can be enormous.
How enormous? You mentioned a crazy example earlier.
Yeah, one source found an ETN in 2023 with an average spread of 12.5%.
12.5%. Just to trade it, you lose that much instantly.
Instantly. Buying and selling right away costs you 12.5%. In cases like that, the source basically said you'd be better off trying to buy the underlying stuff yourself, if possible, rather than paying that massive spread. Exchange traded doesn't always mean cheap to trade if nobody's trading it.
Wow. Okay, check the spread before you trade. Definitely. Now, what about this issuance risk and premiums? That sounds specific to the ETN structure.
It is, and it stems directly from it being a bank note, not a fund. The bank issues new ETN notes whenever it wants to. It's their decision. They can suspend creating new notes for lots of reasons, maybe their own risk limits, hedging costs get too high, regulatory capital issues.
So unlike an ETF where market makers can always create more shares if demand is there.
Right. With an ETN, the bank can just turn off the tap, Supply becomes fixed. Now, if people still want to buy that ETN, maybe it's the only game in town for that exposure.
Limited supply, high demand, price goes up.
Price goes way up. It can disconnect completely from the ETN's indicative value, the theoretical value based on the index. The market price can soar to a huge premium.
And we had an example for that too.
A shocking one. An ETN, because issuance was halted, traded at almost a 90% premium. 90%. People were paying nearly double its actual underlying value.
That's insane. You're paying $1.90 for something worth $1.
Pretty much. And the danger is you don't know when, but if the bank decides to start issuing new notes again, flooding the market with supply,
the premium collapses.
Exactly. That 90% premium example. When the issuer resumed issuance, the price got cut by more than half in 2 days. Anyone who bought near the peak got absolutely crushed, not because the index moved, but because the artificial premium vanished.
That is terrifying. So you have to watch not just the index, not just the bank's credit, but also whether issuance is open or closed and if there's a premium.
You absolutely have to. Check the indicative value against the market price, especially if issuance is suspended. Paying a big premium is pure speculation. Super risky.
Credit risk, liquidity risk, premium risk. Man. This leads right into that recent real-world case from the sources that ties a lot of this together. The issuer having all the power.
Yeah, the Credit Suisse situation with some of their velocity shares ETNs, like the leveraged natural gas and volatility ones.
Yeah.
Credit Suisse decided they didn't want to be in that business anymore for those notes.
Okay, so you'd expect them to maybe liquidate them, pay people out based on the current value.
Yeah, that would seem like the clean, investor-friendly way, right? Close them down, give everyone their money based on the index value, but nope. Not what they did for several of them.
What did they do instead?
They just delisted them, pulled them off the major exchanges like NYSE Arca.
Delisted. So you couldn't trade them on the main market anymore.
Right. They didn't disappear entirely, though. They got kicked down to the over-the-counter market, the pink sheets.
Ugh, the pink sheets. Much harder to trade there, way less visibility. What happened to investors holding them?
It was bad. Volume just dried up. A lot of brokers, especially the big retail ones, either don't allow trading on the pink sheets or make it really difficult and costly. So investors were basically stuck.
Stuck? Like couldn't sell their ETNs?
Couldn't sell easily or couldn't sell at anything near a fair price. Their money was trapped in this now illiquid product. And while institutions might have ways to deal with that, plenty of regular retail investors got caught too.
That sounds incredibly unfair. Why delist instead of just paying people out and closing the notes?
Well, the strong opinion in one source was issuer self-interest. Plain and simple. Remember, no independent board. Credit Suisse could make the call based on what was best for them. The argument is that delisting, instead of liquidating, might let them keep collecting fees longer, or maybe avoid the hassle and potential legal stuff of a formal liquidation, letting the notes just slowly wither away.
So the bank protects itself, leaves investors holding the bag, and maybe even keeps collecting fees. That's harsh.
The source didn't mince words, called it unadulterated avarice, anti-consumer, said it should be criminal. Really highlighted that when you hold an ETN, you are ultimately subject to the issuer's decisions, which might be completely against your interests because it's their debt, not your fund.
Unadulterated avarice. Wow, that really underscores the counterparty risk in a visceral way. Know who you're dealing with.
Absolutely. That whole episode was a stark reminder of the power dynamics and potential pitfalls baked into the ETN structure.
Okay, this is intense stuff. Let's circle back to taxes for a moment, because the sources went into some real detail, especially about that Section 1256 treatment people might hope for.
Right. The tax side is definitely not simple. As we said, the general agreement for most non-currency ETNs is that prepaid forward contract treatment.
Leading to deferral and capital gains on sale or maturity.
Usually. But then there's this question, especially for ETNs tracking futures, like VXX tracking VIX futures. Futures traders often get Section 1256 treatment. 60% long-term gain loss, 40% short-term, no matter how long they held it. Nice tax break. Does VXX get that?
And the tax lawyer analysis in the source said,
A pretty firm no. They concluded there's no substantial authority to treat ETNs like VXX as Section 1256 contracts.
no substantial authority. That's tax speak for don't count on it. The IRS will likely disagree.
Pretty much. You'd likely face penalties if audited trying to claim it. They gave several reasons. IRS ruling 2008-1 doesn't support looking through the ETN to the futures. IRS notice 2008-2. Just said the IRS was thinking about it, didn't approve it.
So no green light from the IRS.
Nope. Plus, industry groups actually argued against 1256 for ETNs back then, and fundamentally an ETN is debt, not a direct futures contract, which makes applying 1256 problematic.
So even if the prospectus mentions 1256 as a possibility.
The analysis says that's likely just covering the fact the IRS considered it. The stronger language is the agreement to treat it as a prepaid forward contract. Don't expect 60/40 treatment on the ETN itself.
Okay, clear warning. If someone really wants that 60/40 treatment for VIX exposure.
The source says trade the actual VIX futures contracts directly. Those do qualify for Section 1256. Don't rely on the ETN for that tax break.
Got it. What about options on the VXX ETN? Same tax treatment as VXX itself.
Another wrinkle. One tax attorney's view in the source suggested options on VXX might qualify for 1256.
Really? Why the difference?
Because they're listed options on a qualified exchange, and the underlying ETN isn't considered standard stock or a narrow stock index. Under the rules for non-equity options, they could potentially get 1256 treatment, even if the ETN itself doesn't.
Good grief. The option might get better tax treatment than the thing it's based on. Definitely need a tax pro for this stuff.
Absolutely. This is not DIY tax territory if you're trading these actively.
Okay, thanks for navigating that tax minefield. Let's pivot to a market where ETNs are actually quite common, the crypto space, especially outside the US.
Right. While the U.S. now has spot Bitcoin ETFs for a long time and still in many other regions like Europe, getting direct crypto exposure through an exchange-traded product often meant using an ETN, sometimes called an ETC, exchange-traded cryptocurrency.
Why ETNs there?
Often due to regulations. Rules like UCITS in Europe historically made it difficult for a fund, like an ETF, to hold just a single asset, like Bitcoin. So the debt note structure of an ETN provided a workaround to offer listed products tracking crypto prices.
So ETNs became the main vehicle for listed crypto exposure overseas.
In many cases, yes. The sources list tons of them tracking Bitcoin, Ether, Solana, Cardano, XRP, baskets of cryptos. Some have attracted pretty significant assets.
And how do they work? Are they just IOUs linked to crypto prices?
Many of them are described as physically backed. This means the issuer actually buys and holds the underlying crypto, usually in cold storage, as collateral against the notes they issue.
So there's actual Bitcoin backing the Bitcoin ETN.
Often, yes. It provides some comfort that the assets are there. However, structurally, it's still a debt note. You, the investor, own a promise from the issuer, not the crypto directly. So that issuer credit risk, it's still technically there, even with the backing.
Okay, backed, but still debt. Got it. The source also mentioned staking rewards.
Yeah, that's interesting. For cryptos using proof of stake, like Ether, Solana, etc., not Bitcoin, the coins held by the ETN issuer can sometimes be staked to earn rewards. Some ETNs pass these rewards back to the investors.
Lower fees.
Yeah, either by reducing the management fees, sometimes down to zero or even negative effectively, or by increasing the amount of crypto each note represents over time. It links the ETN return a bit closer to actually holding and staking the crypto yourself.
Cool feature for those specific cryptos. And just to be clear, these crypto ETNs are totally different from blockchain ETFs, right?
Totally different. Blockchain ETFs buy stocks of companies involved in the crypto blockchain industry. Miners, exchanges, tech developers. Crypto ETNs try to track the price of the cryptocurrency itself using that debt structure.
Crucial difference. So crypto outside the US, a prime example of ETNs providing that niche access, but still carrying that fundamental ETN structure and risk.
Exactly. It shows their role, but you can't forget what they are underneath.
This has been incredibly clarifying. Let's try to boil it all down now.
Sure.
A direct side-by-side comparison of the absolute key differences between ETF and ETN.
Okay, let's do a quick rundown.
Structure.
ETF owns assets. ETN is bank debt and IOU. Core difference.
Main risk.
ETF, market risk. ETN, market risk plus credit risk, the bank might default. Huge addition.
Oversight.
ETF usually has a board looking out for investors. ETN, issuer calls the shots, no independent board. ETF can pay dividends interest from assets. ETN, usually no income distributions until the end.
Tax on gains, general US.
ETF, annual distributions taxed. ETN, usually deferred until sale and maturity. Non-currency, capital gain loss. Currency, ordinary. Complex.
Tracking error.
ETF, can happen. ETN, potentially lower at maturity due to the bank's promise.
Premiums, discounts.
ETF, arbitrage keeps price close to NAV. ETN, can trade at massive risky premiums if issuance stops.
Liquidity.
ETF, popular ones are highly liquid, tight spreads. ETN varies wildly, can be very illiquid with huge spreads.
World bombshell.
ETN, Lehman default, credit risk, Credit Suisse delisting, issuer power, trapped funds.
Wow. Laid out like that, the differences are stark. It all flows from that ownership versus debt structure.
It really does. Every major difference traces back to that.
So the big question then, drawing from all this, given those extra risks with ETNs, the credit risk, the liquidity lottery, the premium traps, the issuer having all the control, for most people just wanting market exposure, is it worth it?
The strong take from one source was basically, no, not usually. For the average investor, the added complexity and dangers of ETNs often make them more trouble than they are worth.
A pretty damning assessment. It suggests stick with ETFs for straightforward stuff unless you have a very specific need, understand the ETN risks inside out, and trust the issuing bank implicitly.
You have to do way more homework with an ETN. It's not just about the index. It's about the issuer's health and the fine print in that specific note's prospectus. Non-negotiable.
Well, this has been an absolutely vital deep dive. Separating these two lookalikes is crucial.
Hopefully it helps you see them clearly now.
Okay, wrapping up. The number one lesson. ETFs represent ownership of assets, market risk mainly. ETNs represent a promise from a bank, market risk plus the serious risk the bank won't pay you back. Watch out for liquidity traps, premium spikes, and the tax headaches with ETNs.
Know the plumbing. Don't assume similar names means similar risks. The structure is everything.
Absolutely. Understanding this helps you choose investments that actually fit your comfort level with risk.
It's fundamental. Structure dictates risk.
So here's a final thought for you to chew on, especially after hearing about Lehman and the Credit Suisse delistings. When you look at any financial product, especially one that's an obligation from an institution rather than a share in a pool of assets, what does the ETN saga teach us about how deeply we need to investigate the issuer, their stability, their motives, their power, even when the product seems simple and trades on an exchange?
That's the multi-trillion-dollar question, isn't it?
Thanks for joining us for this deep dive. We really hope this empowers you to make smarter, safer investment choices.
Until next time.